In 2001, the world was still reeling from the collapse of Enron. Investigators, regulators, and investors told themselves the same thing. Nothing could be worse than Enron. They were wrong. 1 year later, a telecommunications giant called WorldCom revealed it had been hiding $11 billion in fraudulent accounting entries. It filed for bankruptcy, surpassing Enron as the largest corporate bankruptcy in American history. 30,000 people lost their jobs overnight. $180 billion in investor value evaporated. And the man responsible, a former milkman and basketball coach from Mississippi, was sentenced to 25 years in prison. This is the story of Bernie Ebbers and WorldCom, the fraud that was hiding in plain sight, discovered not by the SEC, not by auditors, but by a single internal accountant who started asking the wrong questions. Bernard John Ebbers was born in 1941 in Edmonton, Canada. His family was working class and deeply religious. He worked as a milkman, a bartender, and a high school basketball coach before stumbling into the telecommunications industry entirely by accident. In 1983, Ebbers and a group of friends were having dinner at a coffee shop in Hattiesburg, Mississippi. Over that dinner, they came up with an idea to start a small long-distance telephone reseller called Long Distance Discount Service, or LDDS. Ebbers invested $9,000 and became CEO almost by default. Ebbers knew almost nothing about telecommunications. By his own admission, he didn't understand technology or finance. What he understood was acquisitions. Buy competitors. Absorb their customers. Keep growing. It was a simple strategy. And for a decade, it worked brilliantly. Between 1985 and 1995, LDDS acquired over 60 telecommunications companies. In 1995, the company rebranded as WorldCom. By the late 1990s, WorldCom had become the second largest long-distance telephone company in the United States, behind only AT&T, and the largest handler of internet data in the world. Ebbers became a celebrity CEO. He wore cowboy boots and jeans to meetings. He was outspoken, charismatic, and completely unlike the buttoned-up executives of Wall Street. The business press loved him. Investors loved him. And WorldCom's stock kept climbing. At its peak, WorldCom's stock traded at $64 per share. Ebbers was worth over $1 billion on paper. He used his WorldCom shares as collateral to take out $400 million in personal loans, to fund a cattle ranch, a luxury yacht, a private jet, and a timber business. Then the dot-com bubble burst. In 2000, the tech and telecom sectors collapsed. WorldCom's stock began to fall, and Ebbers, with $400 million in personal loans backed by that falling stock, was suddenly in serious trouble. The pressure to keep the stock price up became overwhelming. Ebbers needed the numbers to look good, not because the business was good, but because his personal fortune depended on it. And that is when the fraud began. The scheme itself was surprisingly simple, almost embarrassingly so for a company of WorldCom's size. The CFO, Scott Sullivan, directed accountants to reclassify operating expenses as capital expenditures. In plain English, costs that should have been recorded as losses were instead recorded as investments. This single trick inflated WorldCom's profits by billions of dollars. Line costs, the fees WorldCom paid to other telephone companies to use their networks, were the largest operating expense the company had. Sullivan simply moved them off the expense column and onto the balance sheet as assets. The entries were made with almost no documentation. Hundreds of millions of dollars moved with nothing more than a verbal instruction or a brief email. No justification, no supporting analysis, Just numbers moved from one column to another, and auditors at Arthur Andersen signed off without question. The fraud ran from 1999 to 2002. During that period, WorldCom falsified over $11 billion in accounting entries. It reported profits it never made. It hid losses that were destroying the company. And it kept the stock price artificially elevated while Ebbers quietly sold his shares. The person who uncovered it was not the SEC, not Arthur Andersen, not any of the sophisticated investors who owned WorldCom stock. It was a 39-year-old internal auditor named Cynthia Cooper who simply started asking questions that nobody had asked before. Cooper had been noticing irregularities in WorldCom's books for months. When she tried to investigate, she was told to stop. When she pushed harder, she was told the entries had been approved at the highest level. Instead of backing down, she worked at night, in secret, to avoid detection. In June 2002, Cooper brought her findings to WorldCom's audit committee. The numbers were clear and devastating. Billions in fraudulent entries, hiding losses that should have wiped out the company's reported profits entirely. The audit committee had no choice but to act. On June 25, 2002, just months after the Enron scandal had supposedly woken up corporate America, WorldCom announced it had discovered $3.8 billion in accounting fraud. The number would later grow to $11 billion as investigators dug deeper. The reaction was immediate and catastrophic. WorldCom's stock collapsed from $64 to less than $1 in a matter of days. Trading was halted. The SEC launched a criminal investigation, and Scott Sullivan, the CFO who had designed the fraud, was arrested within weeks. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. With over $107 billion in assets, it was the largest bankruptcy filing in American history, surpassing Enron, which had held that record for less than a year. 30,000 WorldCom employees lost their jobs. Pension funds that had invested in WorldCom stock were wiped out. Small investors who had trusted the company with their retirement savings watched everything disappear. $180 billion in shareholder value, gone. Ebbers' defense at trial was remarkable in its simplicity. He claimed he had no idea, that he didn't understand accounting, that the fraud had been conducted entirely by his CFO without his knowledge. He said, and these are his actual words, "I know what I don't know. To this day, I don't know technology, and I don't know finance or accounting." The jury didn't believe him. In March 2005, Bernie Ebbers was found guilty on 1 count of conspiracy, 1 count of securities fraud, and 7 counts of filing false documents with regulators. After 8 days of deliberation, the verdict was unanimous. In July 2005, he was sentenced to 25 years in federal prison, one of the longest sentences ever handed down for white-collar crime in American history. The judge noted that the sentence needed to send a message to corporate America. Ebbers was 63 years old. Cynthia Cooper, the internal auditor who had risked her career and her safety to uncover the fraud, was named one of Time magazine's Persons of the Year in 2002, alongside Sharon Watkins of Enron and Colleen Rowley of the FBI. 3 women who told the truth when the most powerful institutions in America were looking the other way. Ebbers served less than half his sentence. In 2020, at the age of 78, he was released from prison on compassionate grounds due to serious heart disease. He died 4 months later, in February 2021, at his home in Mississippi. The WorldCom scandal led directly to the most significant corporate governance legislation in American history, the Sarbanes-Oxley Act of 2002. The law made CEOs and CFOs personally and criminally responsible for the accuracy of their company's financial statements. It transformed how public companies are audited and governed. But perhaps the most important legacy of WorldCom is the story of Cynthia Cooper. In a world where every other institution failed, the board, the auditors, the regulators, the analysts, one person with a spreadsheet and the courage to ask questions brought down an $11 billion fraud. The fraud at WorldCom was not sophisticated. It was not clever. It was not hidden in complex financial instruments or offshore shell companies. It was hiding in plain sight, in accounting entries so simple that anyone who looked closely enough could see them. Nobody looked, until Cynthia Cooper did. Bernie Ebbers built an empire on acquisitions he didn't understand, financed with debt he couldn't repay, sustained by a fraud he claimed not to know about. The ledger of WorldCom told the truth the whole time. Nobody wanted to read it. Until one accountant, working alone, at night, in secret, finally did. Subscribe to Shadow Ledger. Every week, we open a new ledger, and the numbers never lie.